You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it is time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-scintillating Options Insider Radio Network. Check out all 13 programs on said network. Wherever you find your favorite Vol Views program, you can find all of them, including Options Oddities, our latest edition that we record live every day in a very active and quite a raucous chat room, I might add. So it's kind of fun. Adds a little bit of fun flavor to that. We break down unusual activity, all that fun stuff, answer a lot of very live and very sometimes crazy questions and all sorts of other fun stuff. Show charts, screen grabs. You can actually join us live if you're over there on the TD platform every day, noon Central, 1 p.m. Eastern in the Swim Lessons room. Check it out. It's pretty fun, or find it in the podcast archives, wherever you find this fine program, including the mothership, theoptionsinsider.com, as well as iTunes, Stitcher, Aha Mobile, all those fine places. You can even take the RSS feed for the network, pull it into whatever podcatcher you like. We don't care. Or, of course, use our mobile app. It's all baked into one nice place there for you. You can make all your playlists and have all that fun. And then, of course, shoot us some questions and comments while you're listening to the show. We love to hear from you guys. And joining me on the old Volatility Views panel today, starting off, he is the major domo, the drum major, if you will, of research over there at BGC Partners, Mr. Jared Woodard. Jared, welcome back to the Volatility Views program, sir.
Hey, it's a pleasure to be with you on this fine Friday.
It is a fine Friday, and there's some fun stuff to talk about. I'm excited to get into it. But before we do that, we are also joined by the greasy meatball, Mr. Mark Sebastian from OptionPit.com. Mr. GB, welcome back to the program, sir.
So let me get this straight. So Jared gets major domo of research at BGC, and I get greasy meatball, some guy at Option Pit. How is that fair? Explain to me this.
I don't believe I said some guy. I said the greasy meatball at Option Pit.
That's I'm the major domo here over at Option Pit. How come I never get a major domo?
That's your official title, isn't it, on your business card? Greasy meatball at Option Pit.
Just because it's on my title doesn't mean that's what I. Yes, it says founder and greasy meatball officer at Option Pit. I'm the GMO. You might have heard of genetically modified organisms. I'm actually the greasy meatball officer.
There you go.
Isn't major domo like the person in charge of managing a listserv, like an email, isn't it like a 1990s email admin, basically?
See, I thought major domo was isn't that the Styx song? Major domo arigato.
Oh, we're getting all kinds of definitions here. One dated, both very dated. One kind of bizarre, but both very interesting.
Major domo arigato, Mr. Roboto, longo longo.
And there you go. All six of our Japanese listeners just tuned out in disgust. They were deeply offended by that. Before we can offend any others listeners, or maybe we'll offend more, you never know, it's time to dive right on into our volatility review segment.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, listeners, welcome to the Volatility Review segment. This is indeed the portion of the program where we break down the week that was from a volatility perspective, and what a week it was and still is. We are recording this right now, listeners, mid-session here on Friday, October 17th, and I hate the cliche, I hate the term. I vowed to never use it, and yet so far the past few weeks, it certainly is living up to the term of indeed Rocktober. This is the rockingest Rocktober I can remember in quite some time. We've been all over the place this week. We've been selling off down in the nearly 3% range on some of the indices, and then bouncing right back, and then doing the same to a lesser degree the following day. And then today, Friday, all is forgiven, all is forgotten as we rally hard to the upside. Most of the major indices, as of this recording, up about 1.3 to 1.5% on the day. And from a pure vol VIX Cash perspective, it has been a rockin' week as well. We started off the week right around the 20.5 level or so, and then, as many of you are probably aware, got that crazy spike on Wednesday in the teeth of the sell-off, got up to the 31 handle. Haven't been up there in quite a long time. And then cooler, calmer, saner heads prevailed. VIX came off the other side, broke through down into, I believe, actually, it's somewhere in the 19 range briefly. I'll have to pull up the exact number. And then as we are recording this today, listeners, we're hovering right in the 21.5 range. Market can't really tell. It's teetering on that knife edge. Does it want to keep rallying? Does it want to begin perhaps that mean reversion it has been prone to the last few sessions, and we're going to end unched again? No one knows. It has been a quite crazy week, a vol-filled week. You know, we've been talking on the show a lot lately about, whether the realized vol. We were, even when people were saying VIX was low in the 12 to 13 handle in the VIX Cash, realized vol was still in the 5 or 6 range. It was still a dramatic discount to the implied, and not so much these days. 10-day realized getting in the 20 range in some of these indices. So we're starting to see some actual vol in the marketplace, which is always fun for a program like this. There's a lot to chew up, a lot to digest here, a lot to analyze here. So a lot of different places to start. Jared, perhaps we'll start with you. A lot of things catching your eye, I'm sure, this week. Everything was moving, everything was shaking. What was top of mind for you this week? What was really salient that you saw over the week that was from a volatility perspective?
I think that there was the room here for this week for a bit of a victory lap on the part of lots of different people who've been pointing to the expectations for increased volatility in the fourth quarter this year. Some people have been calling for that for years. I don't think we need to give them a pat on the back. I'm thinking of the sort of the gold bug Austrian economist sorts. However, a lot of more even-tempered strategists have been talking this year about how, changes in expectations could reset and could change. People could become more sensitive in the fourth quarter of this year as opposed to the first or second quarter of last year for a number of different reasons. And it sure looks like those predictions have started to come true into October. And so I think the change in character in the market in the broadest possible terms is the biggest headline for me. And I would point not just to increased equity volatility, but also the fact that you had some moves in the market this week on an intraday basis, on a liquidity basis, that pointed to kind of earlier eras from a few years ago, where treasuries are moving and liquidity in those markets dry up. Over the counter, some products that I look at things got eerily quiet at certain points in the day on some sessions this week. So it wasn't just price action, but also the fundamental character of the market that changed a little bit. And I think that's going to be something to watch going forward.
And Mr. Sebastian, same question to you, sir. A lot to watch, a lot to parse, a lot to analyze. What was top of mind for you this week?
Yeah, I mean, just some crazy movement. It was really interesting watching the market basically touch down 10% and the VIX touch over 30, and to see just that incredible amount of program buying of the market and program selling of volatility. But program trades tend to be just that. Now, one interesting thing I've been kind of watching is RVX versus VIX, and all week we basically saw the S&P outpace the Russell, and in many ways kind of catch up to the big Russell sell-off. Well, now the two have normalized, and I'm watching a Russell now down in the day. I'm watching an S&P weaken. I'm watching a VIX that's now moved back into kind of toward 23. The other piece is that it looks like kind of implied and realized they've kind of caught up to each other. So one of the things that really causes market turmoil, a lot of people think turmoil is caused by the VIX being at 50. My general feeling is more of the turmoil is caused by the move from 10 to 20 or 30 to 50 than actually being at 50 itself. Once options have kind of priced themselves properly, liquidity will come back. So the one thing I think that I am seeing today, and a little bit yesterday, is a return of liquidity to the marketplace. There are people that are willing to trade. So as long as the market stays in this range of moving to 1 to 1.5% a day, the VIX might not drop a lot, but we should see more fluid markets and maybe getting pushed around a little bit less by program trading.
Yeah, a lot of pushing around going on this week on all ends of the spectrum. You're right, and it was just looking back on it, just a crazy week from a variety of perspectives. Volume being certainly one of them, records being set across the board. VIX options, of course, flirting with that range. I believe we did 1.8 million on Wednesday, about 1.4 on Thursday. That's, of course, with the recent ADV being about the 600,000 range. So 3x that on Wednesday, which is, VIX is always a very popular item, but 3x the ADV is just a ridiculous amount of paper, pushing over, I believe, about 33 million total contracts on Wednesday, which is pretty much one of the top 5 days of all time, especially when we start pulling out some of the weird aberrations around the debt downgrade and a few other times. So certainly just crazy volume, crazy activity, no matter which way you slice it. Looking into those VIX options a little bit. And by the way, all of you guys who always write in and talk about and ask about, why is VIX so call heavy and is it systemic? And I think we're seeing the answer to that right now. Looking at it, the VIX has actually moved a bit. We're away, of course, from those low teens range that it languished in for quite some time, back when the call to put was about 4.5 to 1. Now that we're in a more, I hate to say normal, but a little bit more, a little bit higher strike price range, we're, of course, seeing that come off quite a bit. The call to put at about 2.1 to 1 right now. So that, of course, shows you that it is indeed a systemic issue. When there's just a paucity of strikes to the downside, by definition, almost, it's going to be call heavy. VIX is always call heavy anyway. When you get down to those levels, it's going to be even more so. So that doesn't really show sentiment like a lot of people might think. It really just shows what systemically is going on with the product. Looking at what people were actually doing with the product this week, the hot places to trade, the hot strikes, if you will, out there in VIX land. The big strike this week was actually the Nov-20s. 367,000 open on that strike, gaining losing, I should say, about 150,000 contracts on that strike. I think a lot of that has come from that guy we highlighted a few weeks ago who just bought a ton of upside, is starting to pare some of that down now. As a result, some of those open interest positions on those strikes starting to come off. Of course, that's not really upside anymore. That's actually downside. So that shows how the frame of reference has shifted in just a week. Number 2 here, Oct-17, 354,000 contracts open. Then out to Jan in the number 3 spot. Usually Jan is farther down. People playing a little bit farther out these days. About 244,000 open on that strike. Down to Oct again, Oct-18s, 238. Nov-22s, number 5, 230,000 contracts. Oct-22s, 226, and then on down the list, Nov-17s, Oct-20s, and then the ever stalwart, ever popular D13 puts taking up the number 9 spot with 188,000 contracts open, and the Oct-21 calls taking up the number 10 spot, 185,000 contracts open. Total about nearly 10 million contracts open in VIX. So this is just size trading territory. No matter which way you cut it. Nearly 7 million of those coming in the call range, about 6.7. A little bit over 3 million in the puts, but still fairly robust action in the puts again these days. Nice to have some put strikes alive and viable again here. Before we get on to anything else, Jared, I know you've been watching a lot of things over there, including what's going on up in the OTC realm. Anything catch your eye over there this week?
What caught my eye was, well, there were some things that didn't catch my eye. There was a really notable lack of liquidity in a lot of different markets on Wednesday, in particular this week, and to some extent on Tuesday as well, where, I mean, there were stories about this in fixed income where you had markets just kind of going quiet at the weirdest possible times, at times when you wouldn't expect. A lot of anecdotal and some public stories about banks that, because of the Volcker rule, couldn't step in and do what they would have done in the years before, the financial crisis. And I saw the same thing in the variance swap market this week. In some cases, I think, where you had people just kind of stepping away who otherwise might have been prepared to come in and do something. I think this is one of those unintended consequences that the reduction in the ability of different market participants to provide liquidity, to take risks within certain parameters. I'm one of the last people on earth to sort of take a oppositional approach to regulation in every circumstance. But in this circumstance, it sure seems like the market has responded and has been adversely affected by some of the effects of recent regulation. And I think we saw the first vestige of that this week. If we do get any kind of genuine market dislocation or genuine big sell-off with really bad economic data, for example, it's a little bit worrisome to think about what the effects might be like in a really serious kind of a market sell-off. And the action this week certainly didn't, I think, alleviate any worries about that kind of thing.
But you're right, Jared. That is an interesting unintended consequence of the regulation. Of course, all those people who play on those OTC variance swap desks are the ones who are being regulated and spun off and cracked down on a bit these days. So not perhaps surprising that some of that volume may dry up. A little bit surprising that they wouldn't find a way to get it done this week of all weeks, because if you're going to be playing out in that realm, this is the week you may want to do it, actually seeing some realized vol in the marketplace, actually seeing some vol in the marketplace. This is the time to be out there. So that is a little surprising that they couldn't get it done this week of all weeks. But at the end of the day, that is perhaps one of the unintended consequences, I should say. One of the other interesting things that caught my eye this week, we talked a lot about a lot of other products in the vol space, including VXST, and it's been an on-again, off-again love affair with this product. It seems like they like it, they don't like it, they like it, they don't like it. I thought for sure maybe this week would be the time when it would really catch fire a bit. I don't have the exact numbers. I'll have to pull them up for Wednesday, but Thursday was another rockin' day. Yesterday, of course, and it only did about 800 contracts yesterday, so it wasn't perhaps lighting up the way some people maybe have thought it would. Today, surprisingly, actually, on a day when we're moving a bit, and there's a little bit going on to the upside, actually. For whatever reason, VXST is catching a little bit of a life, doing about 1,400 contracts today. Pretty much all of that, only 23 puts, so all of that in the calls, which is interesting in and of itself, and about 4,300 open in this product. So it is starting to catch a little bit of life, even if the ADV out here in good old VXST is still a little bit weak. It's averaging, I think, around 800 contracts a day. But yeah, a lot of people hoping it would maybe catch a little bit of fire this week. Not so much. Mark, did that development come as a surprise to you at all this week, that the nearer-term products, like we've said before, it's almost a bit of a broken record now, haven't really caught fire, but of course today, doing actually a little bit of paper?
Yeah, I mean, not much of a surprise. And I agree with Jared. I mean, there's been, I think, we saw a weakness in liquidity, most notably, I think, in the VIX market on Friday and Monday and Tuesday and Wednesday when things were going crazy. I mean, there were periods of time where, I think the only guys that were actually in the market was the DPN quoting, because it went
15 cents wide and 20 up. I mean, so there were some weird times for that, and I'm not exactly sure what was going on.
That's odd. That you think a day like that would be people all hands on deck. Everyone will be out there. That's the time these market makers have been waiting for to actually make some money.
Picked off. I think there was too much volatility for a lot of the computer systems to handle, and on top of that, there's a good chance that paper was so one directional that they were needing to kind of move things around, because you had guys that just wanted to get things done. Basically, one of the best things and worst things about the hybrid system is that in a normal market, it's a good place for retailers to really get a good view of paper, and it's a good place for institutional paper to go down and get a tight market. In a crazy market, institutions sometimes can use that to run over people, and I think that was a little bit of the fear that was going on there. Understandably so, but still.
That's true. For the first time ever, the SPX guys really have to match quote-unquote away markets, even though they're their own markets ostensibly. They don't want to get run over by those hybrid quotes, so that does make some sense. Yes, that's an issue a lot of the equity guys have been dealing with for years, that the S guys are finally getting a taste of that joy. Hey, they bid away. You got to make this good. All sorts of fun stuff. Before we move off S&P and VIX really quick, just looking here at what's going on in skew land out here in S&P land, and it is, it's fairly robust, but perhaps not as aggressive as some might have thought. It's been vacillating right around, it seems like around the 130 handle for the better part of the past week. Got a little bit lower, dipped down to around 120 and got up to about 130, hovering right around, I think, about a 128 or so. So take that for what you will. If you follow the skew index, you know that kind of methodology that they use to quote it, and you're kind of familiar with these ranges. It is getting towards the upper band. I believe the upper band is somewhere in like the 150 or so range. So it is starting to flirt up there, but perhaps not as much as some people might have thought. Jared, what's your takeaway here on the old skew index? Are you once again surprised that things are perhaps not as big as you might have thought, or is this about reasonable in your estimation?
I think it's pretty fair kind of reaction. While we're still in equity land here, you saw a lot of run up in advance of the big action today. You saw, implied vols rising pretty quickly in a lot of individual equities. We talked about this last week, in fact. And so I think a lot of investors were getting hedged and getting prepared as the market, started to really change in the last couple of weeks. With that said, skew is still really extreme, even after the move today. If you look at it on a normalized basis, like 25 delta puts and call IV divided by at the money implied vol, that kind of a measure still has most of the major indexes, not just the U.S. but around the world, near the top, in the top few percentile ranges versus the last few years. So skew is still very extreme even after today's move higher, which means that people haven't really taken off some of their hedges. I think haven't started selling calls or any of that kind of stuff. So there's probably more room for a normalization of skew in the week ahead.
And again, we touched on Russell a little bit earlier. We've been watching RVX with great interest for quite a while. Kind of the same story as VXST. When's it going to catch on? What's going to be the catalyst that moves it? We saw a paper earlier this year when there was a great disparity between VIX and RVX, and that really seemed to drive a lot of paper. We are seeing a little bit of uptake in some paper out there this week as well, including a big 600 lot of the Oct-17s up there these days. If you've been following RVX, that's a pretty decent chunk. Those are pretty deep in the money now, with RVX hovering right around the 26 range or so. So we'll see what happens with those guys, if they'll take them off or if they roll them or what. Also about 250 or so of the Oct-29s also open. A little bit more optimistic strike out there. But still, interesting stuff. And then we get down to the 100 level or so. Open interest, about 1,400 contracts out there, including that big 600 lot. So a few players starting to trickle in there in RVX land, perhaps as we continue to see these indexes swing around and perhaps diverge a little bit more. We might see a little bit more paper rolling into that neck of the woods. Speaking of other necks of the woods, let's dive into some of the other ones. If there was another area of the space that was hot from an underlying movement, from a volatility perspective this past week, it was certainly crude. We were doing one of my favorite portions of our option block program this week, where we play a guessing game where we guess what people who trade certain underlyings on the Options Express platform, in the case of that show, are also trading. And we pulled up Apple, what you might think would be the most retail-friendly, most retail-heavy name, and you'd get to guess what other underlyings these people would trade. And usually you'd guess, the usual suspects, the Facebooks, the Teslas, the Babas, and whatnot, all the other retail-heavy names. And yet the number 1 through 3 underlyings that the Apple traders were also trading yesterday, I believe it were the crude futures, the crude futures out there on NYMEX. So there is a huge penetration for what's been going on out there, and a huge interest in what's been going on out there in crude land. Crude, of course, taking it on the chin, listeners, really getting crushed pretty hard. We were talking about how was it going to pass the 90 handle. Well, it's way past that now, even past the 85 strike to the downside there. And as a result, we've talked a lot on recent shows about how put heavy that skew was getting out there. No surprise now, given the subsequent price action that we've seen out there. It actually looked in the last couple of weeks like we were looking almost at like an equity skew chart, the way it was just so heavily tilted toward investment skew. Actually starting to get a little bit more call up. Still very put heavy, don't get me wrong. That's one of the things that's hard to convey on an audio program, the depth of the skew chart. Jared, what's your take here on just the crazy action we've seen out here in crude land over the past week? A lot of tinfoil hat people out there throwing all kinds of great theories out there as to why crude is taking it on the chin the way it is. Maybe we'll steer clear of those, but what's your take on what's going on out there from a skew and a vol and an underlying perspective?
I don't think I can steer clear of those. Sorry.
Oh no, here we go. Put your tinfoil hats on, listeners.
No, I mean there's a lot of kind of wild speculation. I mean, there's I think a range. You've got from the one hand, I think clearly Saudi Arabia wants to keep its market position in Asia, maybe put a little pressure on the marginal high cost U.S. shale or Canadian producer, maybe put some pressure on Russia. I don't put much stock in the sort of zero hedge type theory of an agreement between the U.S. and Saudi Arabia to really stick it to Russia. That seems a little bit too far to me, but that's
zero hedge's shtick, though. They have to go one too far. That's kind of their deal, right?
Yeah, that is kind of their brand, as it were. But in terms of actual vol movement, it's been remarkable. We talked about skew in the equity space, but in crude oil, both Brent and WTI, you've seen a comparable move to multi-year extremes in terms of a steepness of skew. So that trend we talked about last week, where you had, oil looking like it was a stock in terms of the implied vol skew, is just as true, if not more true now this week. I think that there's some room based on what returns have been like in the past with skew this extreme. There's probably some room for a short-term bounce. But I really think it's going to be driven by actually more fundamentals than normal. If it's true that Saudi Arabia wants to do something, keep oil this low, I mean, they could survive with $85 Brent for I think a lot longer than some people are counting on. So it's possible that the Saudi put, I'm calling it sort of like the Bernanke put, is no longer in place. That they're not going to come in and cut production as they've done in similar episodes in the past. In fact, in September, they actually increased production. So it may be that the oil market has fundamentally changed, at least for the next 3 to 6 months, and that there's more downside to be had.
Jared, another interesting thing that actually got thrown out to me by an oil analyst is that they may actually have to add a third crude contract because some of the stuff coming out of the shale oil is actually of such high quality that it's actually too good a quality to deliver under light sweet in the WTI contract.
That's interesting. That would be a very, very big fundamental shift.
Yeah, that would really change things. I don't know if you'd heard that or not, but that is a rumor I'm starting to hear circulated around the floor. So that would be a major shakeup in the business.
Well, we all know how viable floor rumors are. I can't remember how many times Yeltsin died.
An analyst that I'm not going to name names, but a pretty well-respected oil analyst.
Oh, go ahead, name names. No one's listening.
His name is Mark Longo.
Yes. Well, widely read crude analyst.
He's an expert in crude oil and mock turtlenecks.
I wear both. I do my Steve Jobs impersonation on a regular basis. But you're right, it is interesting to see this. And here I am after saying we're going to avoid the tinfoil hat theory. We get into some of them. Not as tinfoil as some people like. But you're right, Jared. It is still very steep out here, almost equity-like. It seems like looking at this skew chart here, I have the crude up, but it seems to be the same across most of the products. The inflection point seems to be around the 90 handle. That seems to be where people seem to the first time people seem to really be willing to maybe pick up some vol, and we get a little bit of uptick to that curve. Other than that, it's pretty much straight downward. So that makes a little bit of sense. There is some technical, love for those round numbers, those round handles. Maybe people starting to load up a little bit on some upside at around the 90 and above. I'll have to go check out the order flow to see if that confirms it or not, but certainly the skew looking that way. Does that pretty much jive with your recollection as well there, Jared?
I hadn't seen any flow in that direction. Although, to be honest, I don't pay as much attention to option flow in like crude oil futures or we look at USO sometimes. But I think that in terms of the options are high. Implied vol is high, but I really, like I said before, I think that for a lot of investors, the fundamentals and even just the political, not even the fundamental long-term investment thesis sense, but just the underlying production and political issues in play here are really in the driver's seat. You've got people looking at trying to calculate break-evens for different producers in North Dakota and in Canada, trying to figure out just how much pressure Russia can take. And, I really think that kind of stuff is going to drive prices here for the near term, and that until you have more clarity about the fundamental situation, I think there's actually less information in terms of the options market than we would normally get from a relatively ordinary market in oil. So for now, I'm actually less inclined to derive meaning from what happens in implied vol.
Now, I kind of wonder, Mark, just to get into the tinfoil hat theory again really quick, if that rumor is maybe even being circulated by some of the shale guys to say, hey, we're almost a little bit immune from all this selling pressure because we have our own product and it's a much higher quality, and therefore, if that gets listed, they could maybe be a little bit more deflected from the selling pressure from the Saudis.
Yeah, it's an interesting point, and who knows where the shale price really is. Because when you're, drilling for shale, you're ending up you pull out oil, you pull out natural gas, you pull out all these other things. And again, the quality, who knows whether the quality is whether that's true or not, but no one really knows, what does it actually cost them once they get this stuff established?
Well, speaking as the well-respected oil analyst that I am, I've heard anywhere from like 75 to 90 is like the break-even they need to remain afloat, and could even be. I've
heard 75 as well, but that's the more expensive guys, not the big time guys. I mean, it costs ExxonMobil like $35 a barrel or something like that.
Something like that. Speaking as the oil analyst that I am.
Yeah, I mean, I think that. My understanding is that some of the big boys they could go to 50 and make money.
So there we go. We'll see how this dance shakes out as the crude. Definitely one of the hot areas these days. I can't remember the last time I really said that on a show like this, where so many, even of the retail, were starting to flock in and sling things like the DEES futures on the NYMEX crude and stuff. It's pretty impressive. When futures gets that level of penetration into the retail, then something is afoot and the game has perhaps changed a little bit. Speaking of game changing, we've talked a lot about recent episodes about how the energies and the metals, particularly crude and the gold and even silver to a degree, you could almost intersperse all three of those charts. They were so synonymous. They were all so crazy put heavy. They were all leaning heavily downside. We talked about mostly that still staying the course for the most part. In crude, a little bit of inflection to the upside, but still, for the most part, a lot of love to the downside. Metals, though, having changed a bit. Of course, there's been some change in the dynamics out in those markets as well. In gold and silver in particular, we're looking at. And looking here these days, they're nowhere near as one more time. They're nowhere near as monopolistic to the downside as they once were. Not as put heavy as they once were. They're actually getting a wee bit closer to that old traditional smile shape that silver still retained for quite a while, even though gold was getting heavier. If you look at these charts now, you're not going to look at them and say, okay, I'm looking straight at an equity. You'll look at this without any sort of legend, and you could probably identify that you're looking at some sort of commodity, and maybe even guess the metals at that point. Most of the implieds here in looking at gold range falling in the 14 to about 18 or so handle range. Silver hovering about the 25 to 30 or so range in the options on the big futures, and you get commensurate spikes in both directions once you start moving. Does this relative, I suppose you can call it, normalization, does that surprise you at all, Jared, or is that pretty much what you expected given what we've seen out there in metals over the past week?
What's the impetus to buy gold that exists now that didn't exist 2 months ago? That's what I have to ask you. I don't know what it is. Is there an answer to that question? Is there a reason?
Here's my thoughts.
Let's net out dollar, U.S. dollar strength. Obviously that's important for any asset. But right. net of dollar changes, is gold any more or less interesting than it was earlier this summer?
No, but I think the dollar changes are what is making gold interesting. There's a lot of belief that and the bond market is pricing it this way, that now that real rate movement isn't expected till 16, maybe 17, that makes gold, makes gold as a play on dollar weakness a more interesting play. And I think that's where you might see some change in gold.
Okay.
Certainly one of the only things I could think of that would even cause, this renewed upside enthusiasm out here in gold land.
I mean, and that's the theory I'm hearing. That's the theory I would be going with, is that gold is a play on, the fact that basically the 10 years dipped to 2%. And there is now, if you walk around the CME or the CBOE or talk to anybody, there's a lot of people that think sometime next week, a voting Federal Reserve governor will come out and say what the bond market is pricing, which is, hey, 16 or 17.
I mean, I have to lick my chops at the prospect of that. Not because I'm smarter than any Fed governor, which I'm not, but because
let's be fair, you are smarter than a couple of them.
Well, anyway, no, that's not true. Those guys are smart. What I will say is that I guess I'd be selling that view pretty hard, just as my own personal take. I mean, we had I think it was Bullard this week came out and mentioned that maybe a delay in the last bit of QE tapering might be called for, right? And that kind of goosed the market a bit. But I mean, if we think through the implications of that, if the Fed admitted that deflation risk was so material that they needed to delay something that's ineffectual at this point anyway, nobody cares about the last tranche of QE at all, the kind of signal that would send in deflationary terms. I mean, even in that kind of a scenario, I'm not sure that gold is the thing you want to own. I mean, it's a kind of, if you think of gold as a kind of end of the world put option, I think there's a lot of really good assets that can become really risky that can have a bigger payoff than the apocalypse payoff that I think gold investors target. So, I'd be buying downside in credit or in high yield fixed income or lots of places, let's say, before. But, it's a market and people can do what they want. But, I think it is interesting that we've seen the moves that you were talking about earlier, Mark, in gold. And
tips are basically pricing in deflation. And so, even if they don't do QE, I think moving their target to start moving interest rates out to 2017 would have a profound effect on the dollar-euro trade. Mm-hmm. And they've been given the cover, right? I mean, the dollar had, oil falling, food prices falling, corn. They have so much cover to sit and wait that, they might just be so inclined to do so.
I don't know, man. I mean, if you net out, if we look at core PC or core inflation and take into account the fact that lower oil here is only going to be a positive for consumers, is only going to drive demand, then, yes, inflation is lower net of including energy. But this is a good kind of low inflation, right? I mean, we're getting, this is positive for demand. And small business compensation plans is a key data point I've been looking at lately.
Yeah.
The number for September was still high, as high as it's been all year. Average, if you run a regression on those compensation plans and average hourly earnings year over year, you get a pretty nice line, and a line that implies, based on historical data, that year over year earnings growth by this time next year will be 2.7% even, which is the kind of change I think that would be have people screaming for the Fed to move. And if we see, any of these compensation plans come to fruition over the next 3 or 4 months, I think wage growth, after the new year is going to be enough to get the Fed to have, some fire in its belly. So my outlook is for the June meeting for the first rate hike, and I probably will be wrong, could be wrong, but I can't see the Fed sort of saying we're not going to do anything after they've worked so hard to gradually guide the markets without actually sparking the reverse kind of deflationary fear reaction at this point. And I mean,
I agree with you, but the bond market is I get that logic, but the bond market is not pricing it that way.
Well, look at if I look at the euro-dollar curve, against the Fed's the famous dot plot, the median levels in that dot plot, and how that's changed. Mm-hmm. You can, the 90% interval even in euro dollars, where they're priced now is still within spitting distance of the Fed's forecast. So if the market starts to narrow at all in the Fed's direction, if wage data just ticks favorably a little bit, I think you'll have euro-dollar options priced not too far from where the Fed, still within a high confidence level kind of a range, but it's not out of the bounds of possibility at all, as far as I can tell. And yeah, this week didn't help in terms of that spread widening. But like I say, I think that a few prints in the next couple months could really change perceptions in a big way.
Since we're touching on rates, we should hit on those as well before we roll out of the vol review, actually. And some vol, not surprisingly, being exhibited out there in the rates land, looking at the 10-year, of course, where a lot of the action was, and not surprisingly looking at vol skew. Vol ticking up, as well as, not surprisingly out there, upside where a lot of the love is in the bonds these days. Looking at a lot of upside call love here, and the skew gets really steep. We also saw some weird aberrant action in some of the rates-related products. Mark, I know you like to watch TLT a lot out there, and we saw some crazy paper out there and crazy movement out there. I believe it spiked to, what did it get to, about 127.5 or so on Wednesday. Like I said, I know you watch TLT a lot. Was that just an aberrant print, or was there actually paper going on driving?
It traded above 120.25 for some time. I mean, trade of the week was TLT versus SPY, short both of them, and that worked out really well. And yeah, I mean, bond vols starting to pick up. I mean, really, as Jared has said, vols are up unilaterally. You name the product, vol is up and has been creeping up since basically July. One interesting thing, I mean, the VIX bottomed out in June, and the S&P topped out in September. So there is, I think we're in a new tranche. I am now thoroughly convinced that Jared is right, and we are in a new tranche of volatility, and we need to reset what is kind of median volatility back somewhere into the upper teens and away from kind of the 13, 14 people we're looking at.
A new tranche. Do you agree? You both agreeing on the show? I mean, we might have to end the show right here.
I know. Well, if only we didn't have a 45-minute vol review to discuss different topics.
And we're agreeing on vol from the long side, which is even more unusual, I think.
Yeah, totally. And the funny part here, folks, is we were discussing we might have to do a few extra questions because we weren't sure on show topics and we don't have a guest. And of course, what happens? We fall down the rabbit hole of long-term volatility trends and Fed policy. But our blathering is your game, folks.
That's pretty much the mantra of the network. Our blathering is your gain. But we do want to give you guys a little bit of time to shine as well. Of course, a lot to digest this week, so I expected the vol review to run long, and we love to get into all the weeds here. That's what this show is all about. But now it's time for you guys to share your questions and comments. It's time to open up the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, like the man said, this is your attempt, your chance here to join us on the old Vol Views panel. Make your questions or comments heard. We'll see if we can get through a couple of these, starting off with a question from listener Neal Max. He writes, sounded like you guys were a little skeptical regarding the VolDex product. What do you think of this product's chances of actually making it to market? Do you think it has a shot against VIX? Mark, of course, you didn't join us last week. We had Scott Nations from the VolDex on and Nation Shares to discuss this product and what they're planning. This product is still a little loose. It's still mostly theoretical at this point. But, of course, they are planning that implied product that essentially strips the skew out of VIX, to put it essentially in layman's terms. It essentially, in many ways, is going back to that old methodology that they used to have of the VIX, where they used to run it on the O, not the S, but it didn't have all that skew component, and then they switched it to the S, and they added the upside, downside skew and a few other things that some people have been lamenting about ever since. Clearly, they would be interested in a product like this. So maybe before Jared and I weigh in, because we've already had a chance to talk to Scott and kind of weigh in our opinions there. Mark, we'll give you a chance. I know you weren't on the show last week. What's your take? I know you're familiar with it, of this VolDex product and its general chances in the marketplace.
Yeah, I mean, general chances in the marketplace. Well, the SIBO keeps issuing all these different things that nobody trades. I don't see why Scott Nations would be any different. My hope is he's wrong. I think competition is good. A straddle-based product's a good idea. I think as you start to limit the number of strikes that are really calculated, you start worrying about people, about weird prints and weird pricing. So they're going to have some things to work through there. But, I think in theory, it's a great idea. But there were some reasons why the SIBO moved away from the VXO. In addition, one thing to think about, part of the reason for the success of the VIX really is more the fact that it has it's a natural hedge for the variance guys. Whereas, I ask what is the natural use of the SDEX product? Who's their natural user? Without a natural user, products typically don't end up working out. And I think that is the one thing that may be their biggest problem.
Yeah, Scott claims their target guy is, the pro who just wants the straddle runs of essentially the at the money implied, and he doesn't like that he's getting all this extra information with the VIX in the terms of skew and all the other things that are going on.
That's a limited audience.
That certainly could be argued, and that's one of the things I tried to bring up on the session. I don't think we had much time at the time, but essentially there was a reason that SIBO added that information, and that there are people who do derive some value. They feel that skew is an important component of what's going on out there in VIX, and there is paper flow there. It should have some impact. Of course, there are others who think I just want the at the money implied, and maybe that skew data belongs better in a separate product, which is of course what Scott's trying to do there with both of those. So there certainly are two sides of that coin, but I do feel that there is some important information to be gleaned from that skew. Of course, there are times when it's distortive as well around settlement, and we've talked about that many times on the show. In terms of what I think of the product's chances of making it to market, one of the reasons I stressed the underlying question so much when Scott was on is that seems to be where the rubber really meets the road for a lot of these products. They have these great conceptual ideas, then at the end of the day, they launch without an underlying, God forbid, or they have a hard time really getting an underlying that is viable. That seems to be the real big stumbling point for a lot of these products. And that's why I tried to stretch out with Scott a few times. They don't have any clarification on what exactly it's going to be or when it's going to launch. So we'll have to check back when a little bit more is available on that. But that for me is my biggest stumbling block. If they can figure out the underlying and make something viable, not some crazy esoteric thing, then there might be a chance for, at the very least, people who want to arb between, let's say, old VIX and new VIX, which is essentially what this is. Jared, what's your take here for our friend, Mr. Neal Max?
I'm not going to declare any product a failure before it even launches. You never know what kind of nascent demand is out there. I would agree with you guys. There's some interesting features of the product that, let 1,000 flowers bloom, right? I have my pet theory as well with regards to new financial products, which is that the economic cycle and the very big picture probably matters more than the intricacies of a given product, at least more than we're sometimes inclined to assume. So launching this 2 or 3 years ago probably would have been actually not a great idea, just given what was happening in terms of in the economy and the market overall and investor participation. But now the volatility is picking up and the economy is stronger, and you see a lot more investors coming back into listed markets. I think that there's actually better odds for products like this than there would have been a couple of years ago.
One point I do want to make, it kind of follows on what you were saying earlier, Jared, as well, the point about the regulation squeezing a lot of those guys out of the OTC realm, where we've seen a similar impact in the market-making realm in the options space, and a lot of these firms are much more reticent to adopt a new product than they were even a few years ago. Witness the surprising deaths of seeming home runs like the minis and others as perfect examples of that are our own friends over there at VolDex, who launched a product and had a hard time getting traction. These firms really are just very reluctant to adopt any new product until there's paper. And of course, it's that chicken or egg conundrum then of where do you get paper if the markets are $2 wide? So that could also be a big stumbling block to this. Even if the product is perfect, even if the scenario is ideal, if the liquidity providers don't embrace it up front and make it tight enough to attract paper, then it could wither and die on the vine. And there's no indication that those firms, at least these days, are showing any more willingness to let's roll the dice on a new product. If anything, it's the opposite. They definitely play wait and see, and of course that means the customers do too. And that's the problem and the dance that a lot of these new product issuers are going to have to deal with. Well, we got a few more questions in here. I know Don S. has written in with some epic ones as well. I want to make sure I get to him, but we are kind of running short, so we'll make sure we get to those on another episode. We will do our extended listener mail, I promise you, listeners. Meanwhile, we're going to keep on rolling right on into our Crystal Ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the Crystal Ball.
All right, listeners, and if there are any compliance officers listening, just turn it off right now, because we are about to blow your minds with the craziest, wildest, perhaps most reckless volatility prognostications known to man. And when you think that, you think none other than Mr. Jared Woodard. Jared, take it away, sir. The floor is yours.
I have So I predict for the fourth quarter average VIX closer to 18 than it was to 12 this year, and I expect that oil markets are going to stay interesting. And I expect that there's going to be a decent rebound in equities, that we're going to have maybe consumer discretionary, and that's the kind of front of a lot of people's minds right now, seeing a rebound into the holidays as we've got lower oil, decent sentiment among consumers overall, I think, and some really good tailwinds to the retail part of the economy. That's a recipe, I think, for actually declining option premiums in some cases, even if the markets stay interesting on a net basis.
And Mr. Sebastian, you're no stranger to offending compliance officers. So what do you have to say for the week to come from a vol perspective, sir?
Yeah, I mean, I think we've got a little more. I think we're going to test down again. I think we're going to see things move potentially a little lower at the beginning of the week. I'd like to see us test that 10%. And test the program buying again. And then, like I said, I think we're going to hear something out of the Fed, or equity markets are going to start guessing that timetables at least have moved back a little bit. And we could rally on that news. And, I agree with Jared. I have moved from with my directional opinions, I've moved away from kind of buying things and into selling things because I think volatility is going to be higher and is higher, and that's going to be the better way to play things. So when you feel a direction one way or the other.
Well, I know of at least one listener who will be happy to hear you say that, sir. All right.
I know. Can you imagine I'm saying I want to sell something?
I know. Crazy town, sir. I've never heard such madness before here on this program. Before we can get even madder and crazier, we're going to close out the old crystal ball segment. That's also going to do it for this episode of Volatility Views. But before we go, as always, let me check in with each of my cohorts here, my compatriots on the Volatility Views program. Mark, perhaps we'll start with you. What's cooking in the land o' the pit?
Next Thursday, I'm doing a presentation using volatility to trade direction. That should be great. Should be a really good time. We're offering a replay of the VIX primer that we did on October 4th for $27. Go to optionpit.com/VIX primer. That is a freaking steal, folks. Take it.
There you go, folks. A freaking steal. That is our technical term here.
Indeed.
For the day. Go find out. And Jared, what freaking steals do you have to offer our listeners?
At the low price of free for clients, I'm working on a good dive on oil. Actually, looking at break evens for a lot of the big Gulf countries and Russia and some oil producers, and looking at how the options market has reacted in some of these individual names as well as in the sector, with as deep a dive as I can muster to get some insights, hopefully, into positioning for the next several months. And so I'm pretty excited about that. A lot of that work already done. We had, I think I spoke about this last show, maybe 2 shows ago, one of our VIX straddle strategies that we've talked about this year signaled long vol before markets really got moving this month. And we're probably going to be taking that off shortly. So there's a lot of exciting shorter term, actually, trading oriented strategy work to be done. And that's all coming next week. So people can look for that.
All right. Thank you for that, Jared. And of course, on behalf of Jared and Mark and myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing and for sending in such great questions. We'll get to more of them on the next episode. Don't you worry. And we'll see you, of course, right back here next week for more Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.